For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Hey, let's manage your financial future. What do you say? Thank you so much. Welcome back to the podcast. Episode, by my count, episode number 150. Professor Rick Plum, 150. Seems like we've done more than that, but I mean, 150 is a lot. Once a week.
This is the podcast. I mean, we've been doing radio, TV, podcasts for 30 years.
I found, where is it? I found, this means nothing to anybody except me. I found a tape. I have a cassette.
A tape? What? A tape?
Somebody gave this to me.
Were you at the Goodwill or something?
A cassette tape yeah. They had kept this from our show. This is even before you.
Yeah, this is before I joined. That's
from
1992.
1992. It's a white
Holy
cassette
cow.
tape. It says Financial Planning Hour.
One of the early radio shows.
B100 76 KFMB on it.
Now the question I have is, yes, you found the cassette tape. Do you have a way to play it?
I don't. Well, somebody had digitized it for us, and I have to listen to it. But John Leatherwood got this for me.
If somebody gave me a cassette tape, that'd be really cool and all, but I have no way to play it.
I don't either. But our friend John Leatherwood, who works here with us, says he's digitized it. So I'm going to have a listen to this and see. But it talks about the All-Star game
pre-me.
In 1992. It says we have tickets to the All-Star game, 1992 in San Diego.
Wow.
So if you want to see all those All-Stars from 1992. So I just, again, that means nothing. It's apropos of nothing. But it just, once again, hey.
Well, it talks to the issue of how long. It may only be 150 podcasts, but we've been talking and dealing with financial issues, financial planning, and all the things that go along with it, creating, investing, taxes, Social Security, pensions, all that kind of good stuff for a long time.
Long time. And, I mean, back then in the early 90s, here I am, I'm almost 60. You're a little over 60 yourself.
Welcome to the party, pal.
That's exactly right.
Almost 60. Wow.
Yeah, and I got to thinking about back then the things that I was saving for. I mean, I was 28.
And you were saving at 28. That's better than most 28-year-olds.
Wasn't saving like I should have been.
Well,
but I was, here and there. We wanted to buy a house. We were. By that time we had bought our house. Doggone it. Well, even prior to that, okay, and this speaks to what we're going to be talking about on today's podcast here. So there is a connection to what I've been saying.
Let's bring this full circle.
Into the actual topic. And how quickly time seems to go by, and how saving early and saving often is a real ally. I want to talk about building, building wealth, let's just say building a nest egg or building savings.
Okay.
Right? Versus
building
keeping
net worth.
Yes, versus keeping it. You spend presumably you spend between your 20s and your mid-60s, call it mid-20s to mid-60s, that's 40 years, building, saving for things along the way. And then you spend your mid-60s till the end trying to preserve that wealth and use it, but you don't want to run out.
Right, you don't want it to go to zero because then you have no income either from that area.
Now,
cash flow, I should say.
There are people who get pretty good at saving, and they learn how to do it, especially people who do it on a regular basis. But what happens oftentimes is when they reach the age where they got to reverse that process and they start taking money out, they become very frightened and they don't know what to do. And this is where financial advisors and planners can help. So let's start off, first of all, with how does somebody build a net worth?
Well, the hardest part about creating net worth isn't knowing how to invest. It's not understanding the markets, understanding the difference between a growth mutual fund and a value-oriented mutual fund, or even the difference between a stock and a bond mutual fund or a stock and a bond. None of that matters unless you pry $1 out of your wallet and put it into an account for a long term, unless you somehow create the savings aspect, the ability to move money out of your current income, out of your current checking account, savings account, into something that is designated more long term. Now, so I'm not talking about, we have to have some money in cash to make them monthly bills. We have to have some money in cash, hopefully, to meet some unexpected bills that come along the way. But over and above that, the hardest part about creating wealth is the discipline of saving, the discipline of moving money from one pocket to another, out of sight, out of mind. And that's where most people don't get started, because they never build any wealth because they never get started. You have to start somewhere. For me, and it's not the same for everybody, it was when I was younger, my auto insurance bill killed me every year. Every year it came along and it was X amount of dollars, whatever. And I was like, man, I just don't have, where am I going to get that? It was a decent sized number at the time for me at the time. It was like, and I'm always scrambling for the annual bill or the semi-annual bill. I can't remember anymore whether it's been so long. So what I did one year, I said, okay, forget it. I am going to take what I expect the annual bill to be and turn it into a monthly allotment. So I created my own sinking fund. I created my own side fund. I had money taken out of my checking account automatically, equal to the amount that over the year it would grow to amount, so I could pay my dadgum bill.
So you were setting money aside to give to an insurance company.
So it wasn't a Christmas fund; it was an insurance fund.
Yeah.
And what I found was, once I got it started, first month or two was like, oh man, where's the end of the month? End of the month can't get here quick enough so I can get my next paycheck. But then I got to the point where, well, this is working. And then when the bill did come, I may not have needed the entire savings to pay the bill. And so I had some money left over in savings. And so then I started just incrementally increasing.
Yeah,
so I started at $25, $50 a month. I don't know what it was, but I bumped it up by 10 or 15, $20 or whatever. And I kept bumping it up. And before I knew it, I'm like, I was actually saving money and I didn't know where it was coming from. It was coming out of my monthly paychecks, per se, because it was going into savings or going into checking and then coming out of checking. But as far as the budget, I don't know which category of my budget I wasn't spending that money on anymore. It was that part of the budget where it says miscellaneous, that was somehow not being spent as much. It was going into savings. And so then it was just a matter of the discipline of building up my emergency fund, getting an emergency fund, making sure I was out of, high interest rate credit card debt, building up things, and then identifying, okay, what is the next thing I'm saving for? Got my bills covered, got my non-monthly bills, got them covered. What's next on my list? Let's start saving for that house, whatever.
Can you do this, though, without an increasing amount of income?
I didn't increase my income in that period of time.
I think people tend to think, well, I can only save for a few things at a time.
Well, that may be true.
Now, we talked last week about
but some people say I can only save for a few things at a time, and they end up not saving.
Yeah.
Like I mentioned, the hardest part about creating this is getting it started. You said, I wish I would have saved more. Hey, at least you saved some. But the idea is you need to get it started, and most likely, for most people, you need to get it started and done automatically. Don't give yourself the opportunity to not make the payment.
So let's say you do that. Now you get started, and you're putting a certain amount of money away. Now, somebody who's 25, and we're going to get to the people who are retired in just a moment.
As you progress through age, we'll get there.
Yeah, but for somebody who's in their 20s or so, somewhere in there, they've got, of course, retirement, which is 40 years down the line. Last week we talked about, if you only can save for college or retirement, we said save for retirement, right? Or whenever the episode was. Save for retirement and save for college if you have anything left over. But, people who are young usually have at least a few short-term goals, plus their retirement goal.
Well, as I mentioned.
So there's a lot to save for.
In my progression, the first goal was to get my non-monthly bills covered.
So your short-term was?
My savings was the monthly I could deal with. It was those ones that came up every 6 months to a year that were bigger numbers. Let me get those covered. Then the next thing was I need to build an emergency fund, make sure I'm out of debt too, for that matter, any high interest rate debt. And now once I've gotten past those, what's next on my list, my hit list? Is it to save for a house, or have I somehow been able to buy a house before this? If it's not for the house, what's next on the list? And that's where you get into the question of education, if you have kids at that point, or retirement. And we get into where are we going to allocate these dollars? In my progression, it was, savings, monthly bills, periodic bills, emergency fund, then investing for longer term growth.
So that would be retirement at the end of the list.
Actually, at that time, retirement seemed like so far away.
Well, that's why.
I wasn't investing for retirement per se.
It
I was
just
investing for the future.
Yeah.
Investing for something that I knew I wasn't going to need in the next 10 years. Maybe it was, a huge vacation. Maybe it was, I didn't have a specific retirement goal necessarily at that time. I had no idea what retirement looked like. I'm still not exactly sure because I'm not retired. But I wasn't saving for retirement. I was saving for long term.
Okay,
but that identified how I was going to save. Now comes so there's a couple ways to deal with this. Once you get the discipline down, once you get the idea that you've got all the bases covered and now you're saving for the unknown, the future, whether it's retirement, call it what you want. But we know it's long term. Now, how do we go about investing the funds that we're setting aside? And depending on who you are, and whether or not, I've seen people do it with bank accounts and things of that nature and save, but they end up saving a lot more money or out of their pockets because their money's not working as hard for them. But they're more comfortable with that than seeing their money go down in value even a little bit. Other people may be able to save more over time because they let the markets work for them because they understand the long-term nature. And that's what we have to understand about the individual who's doing the investing. Most of us are going to want to start investing for long-term, which means there's going to be some volatility. But the good news is, especially for the younger people, volatility is your friend. If I'm saving
for the long term,
when you're investing long term, volatility is your friend.
Absolutely.
If you're investing
dollar cost
$100 a month, make $1,000 a month, whatever the number is. If you've started that and you're 3-4 months into it, you've got $300 in, $400 in, and the market craters by 50%. Yeah, it's emotional. You just watched half of your net worth go away. You watched $400 turn into $200. But then your next contribution increased it by 50%.
If you're saving $100.
If you're saving $100. The money's right now. You want that volatility. You want it to stay down. A 25-year-old wants the market to crater or go flat for the next 10 years, and they want to save, but they don't. But they want to save it and buy as many shares buy as much as you can while it's on sale, and then let it recover. 65-year-old moving forward, and they think they don't want that. They have to protect against that. So the goal is, and how we use the market is different depending upon what we're trying to achieve.
Yeah. So very quickly, if somebody who is young here and they've got $100 a month, $150 a month, something like that to save, and they've got their long term, but they've also got 2 or 3 short term goals, right? Do they take that $100 and divide that up a little for the short term, a little for the long term, or is it better to just in 5 years, I want to...
Well, define your risk tolerance. I mean, a lot of times, the short term is 5 years. They'll take the risk of the market and say, you know what? I'm probably going to be short for that house down payment anyway. So I'm going to need, so I better go for the gusto and try and hope that the next 5 years, dollar cost averaging does well for me, rather than just putting it into a 3 or 4%.
I agree with that. My assessment would be, look, put it into something that's got some element of risk to it. In other words, but it's also got growth potential, like you would do in a 401k. Put the money away into some kind of growth asset. Would you agree?
Yeah, I would agree, especially for younger people.
Yeah.
But for older people, it becomes a different game.
Well, yeah.
Risk tolerances change. But specifically for that younger person, I really like the idea of doing Roth IRAs, investing for at least 5 years for that down payment on the house, because then I can use the Roth IRA. I can use all the money I've put into it, my contributions. I can take them back out for any reason, at any time, for anything I want. No penalty, no taxes, no fuss, no muss. And if it's been at least 5 years since I've had the Roth IRA, I can use up to $10,000 of the earnings first, get $10,000 of earnings, in addition to all my contributions, and use that whole thing as a down payment for my first-time home purchase.
Yeah, I happen to agree, and I'm glad you said that, but the idea is save early, save often, and just keep doing it, correct? Would you agree with that for a young person?
Oh, yes. Save early, save often.
And would you generally say, let's make it aggressive growth, or would you...
Let's go back to what we're trying to save for. Are we trying to build our peace of mind and get an emergency fund?
We're trying to just build it up.
We're just trying to build it up with no specific goal time. Yeah, definitely go for it. Use the volatility. The markets, we can't guarantee anything out of the markets. And I'm not sure I can even say that I can guarantee volatility, but I'm pretty sure volatility will be the name of the game with the stock, with any of the markets. They go up and they go down. The only problem is we don't know when they're going to do either direction. So use that volatility to your advantage over that long-term saving. Use that dollar cost average. Most of us didn't. You never probably had a big lump sum to invest at one time. I mean, the only time younger people have that is if they get an inheritance. And that may take a little bit different type of investing. But for most of us, it's prying money out of our pockets to put into our investments. And we do that systematically. The only way it really works is systematically. Have it done automatically, maybe put an escalator on it. But that systematic creates the advantage. It gives you that dollar cost averaging. Now, dollar cost averaging does not guarantee a positive return. It just helps use the volatility to your advantage. And over time, it can help you enhance whatever return you might have had otherwise.
So use risk to your advantage.
Use that volatility to your advantage.
Okay, so that is really the key to building a net worth, building a portfolio, putting savings
save early, save often, and increase
and
it.
work toward wealth.
What I was saying is, as I got used to it, I kept increasing the monthly contribution to a point where I'm looking back saying, wow, I'm saving how much right now?
And look how it's built up.
Wow. It's doing something. And
it's great. 10% of 1,000 is a lot less than 10% of 100,000. So, I mean, really, when you build that up and you have interest upon interest, it does make a difference. All right. So, having said that, that is the way you would work to increase your wealth.
Right. That's the way to create net worth.
Now you got to turn it around. And here's where people oftentimes get tripped up because they don't know how to withdraw it. They don't know how to turn it around and turn the spigot back on themselves.
Creating net worth, well, like I was talking about, means using the volatility to your advantage. And
taking some risk,
probably. For a while, yes.
Yeah.
Protecting means managing the volatility or managing the risk.
Doing the opposite, really.
Yes, we don't want to have that risk. I mean, like I said before, if I've just started off on my savings and I've got $400 in there and the market crashes by 50%, $200 to me at that time was a lot of money, but it wasn't going to make or break the difference in my retirement 40 years later. If I've got $1 million at retirement and the market craters by 50%, and now I've only got 500,000, that's going to leave a mark.
Well, that's where people get afraid. So,
right. And
so we talked about building wealth. Let's say you've managed to build that wealth, and now you're 60, 65 years old.
We have to find a way.
What do you do to maintain that wealth and not run out so that it potentially not run out? How do you work toward keeping it?
Well, one of the most obvious ones is spend within your means. If you remember the call we took on the radio years ago. The gentleman had $300,000 and he wanted to spend $30,000 a year plus, and he was only 60.
10%.
He wanted it to last until he was 90. Yeah. That is not a reasonable goal. So obviously, if you've got a spending goal that's 9-10% or more of your investment net worth, it's probably not. No matter what you do, it's not going to work.
No, and this is where we talk about 4%, 5% distribution guidelines and rules and all that stuff. Would you say that when you've built that up, take a look at about 4 or 5% of that and try not to...
From the 30,000-foot level, yes.
Yeah.
The idea is, what am I spending out of my portfolio? But it's not, that can change, though. If you start off at 7-8% distribution because you haven't started your Social Security or pensions yet, and then 3 or 4 or 5 years down the line, you start your Social Security pensions. Yeah, what is my distribution look like once everything is turned on?
That's tolerable. Yeah.
So what are we going to look like then? So, but from a 30,000-foot level, if you're saying, you know what, I want to retire. I'm 55. I want to retire at 65. I'm not sure really, but I'm 65. My Social Security will be X. I'll have a small pension of Y, and I think I'm going to need X amount of dollars per month. If that delta, that difference between what's coming in and what's going out, including taxes, is in that 4 or 5% range, big picture, you should be okay, assuming you invest correctly.
All right. So let's say that someone has done that. They built $1 million, and they say, all right, I've worked my expenditures so that I can, about $40,000 a year, somewhere between $40,000 and $50,000 out of my $1 million. Again, I'm using $1 million because it's easy math.
I know everybody out there's got 10, but we're just talking about $1 million here.
Well, yeah. All right. So they say I've got my $1 million, and I'm going to go between 40 and 50,000 a year. I've decided that that's what I can do. Now the question is, how do I keep this money from running out? Because even if I'm only taking 4 or 5% out, Professor Plum, people's big fear is that something's going to happen, that their $1 million next year, because of a market crash, will go down to $800,000. You know where I'm leading to in this discussion.
And I'm going to say, before we get to the answer, that one of the problems are we get lulled into a sense of apathy almost. And I'm going to blame general investment guidelines, but also target date funds for this. The idea is that as we start off, we're investing aggressively, we're dollar cost averaging, and then as we get closer to the goal, we start paring back on the aggressiveness. We go from 100% stocks to 90-10, 90% stocks, 10% fixed income safety, 90-10, 80-20, and we slowly move our way down, and we somehow believe in the old stupidity of take 100 minus your age, and that's how much you should have in stocks. Or is it how much you should have in bonds? I can't remember, but either way, it's a dumb idea.
To reduce the volatility.
To reduce the volatility in your portfolio. And target date funds, we're going to do this all for you automatically. Don't worry about anything. Don't worry your pretty little head. Just put your money in here. And as you get closer to that target date, we are going to change the allocation to a more moderate allocation appropriate for the time horizon that you have selected. And so you go from a 95-5 stock bond allocation, and as you grow and get closer to that target date, it changes the allocation from a more aggressive, more stock-oriented portfolio to a more balanced stock bond portfolio, and maybe even one that's even more bondish heavy as you get close to or at the target date.
Because stocks are risky, and
you don't want to be all risky.
Yeah.
But what they also do is they take your ongoing savings that you're putting into that fund, and they start allocating it to the safer areas. You're losing the one thing that the market gives you, that volatility, the advantage of the volatility, saving in the dollar cost averaging. So you're screwing yourself up with that. Now you're close to or at retirement, and you've got this nice balanced portfolio that looks real pretty. And what happens if you were retiring in January, February of 2022? Everything was looking great up until then.
We'd hit stock market all-time highs at the end of 21.
And 2022 happened where stocks and bonds went down.
Those are the people that if they didn't have a strategy set,
and so
they were the ones who got in trouble.
A balanced portfolio, a target date portfolio style distribution portfolio took it on the chin. Not only, let's say you took your 4 or 5% out, so you went from $1 million down to 960, just because you took your 40,000 out, and the portfolio went down by 10, 12, 15%. And unfortunately, stocks and bonds went down in 2022. And so your portfolio did get closer to $800,000. Now you're taking a bigger distribution. The distribution probably could have survived depending upon what happens in the next couple of years. But the distribution can't survive the emotional aspects of people saying, oh no.
Well, they would have panicked.
They panic and they sell out, and now they're down and there's no way to recover. So the way to actually create a stable cash flow, or a more stable cash flow from your portfolio, isn't to just change it to a balanced portfolio. Yes, as you get closer to retirement or to that date where you're going to start spending money from the portfolio, you move away from 100% stocks, and you start moving into areas that are either more balanced oriented or more fixed oriented, so that you identify how much you need based on the time horizons you're dealing with. And then when you do start taking money out of the portfolio, you don't take it out of the entire portfolio. So the day before you actually retire, you look like, if you looked at your whole portfolio as one big picture, it looks like a balanced portfolio. You may have 35% in stocks, 30% in a midterm, more moderate account, and then 30% in super safe stuff. So it looks like a very well allocated, balanced portfolio. The difference is what comes next. When you start taking money out of it, unlike the balanced portfolio that's being used as a whole, or the target date funds that are used as one portfolio, and you say, send me my $40,000 or whatever number it is, and they take a little bit out of every little slice of the pie. Yeah, they take a little bit.
Bad idea.
Or they take it all from cash one day and then they just rebalance the thing the next day.
No.
You don't take it from areas that were down in value. You take it from areas that are safe.
So in the example,
you bucketize the dang thing.
There it is. so your $1 million that you had, and you're ready to retire. You let's say you did. So you have 300 in cash or not.
So let's say your balanced portfolio. You took that $40,000, but you took a third of it from your stock portfolio, a third of it from your bond portfolio, and a third of it from your cash portfolio. That means there's a third. What's that?
12,000, 13,000,
or whatever.
Oh, 13,000 a year.
That's you sold $13,000 worth of stock, $13,333 worth of stock. So when it came back this year, that $13,000 didn't recover, and when the bonds came back this year, that $13,000 didn't recover. So rather than that, even if you had the same allocation to start with, a third, your stocks went down by 18-20%, like the S&P or whatever your experience was for the year.
But you didn't sell any of it.
Yeah. So when it came back this year so far, we'll see what happens coming up. You've had a recovery of all of that portion, not just a portion of that portion of your stocks.
So divide it up into something of a non-volatile, partially volatile, if you want to call that the midterm, and volatile. And then, it's buckets. It's buckets.
And you spend the safe money. If you're going to spend $40,000, it's coming from the principal and interest that you've earned on your safe account. $1 is $1. It didn't grow to $1.12, but it also didn't drop to 85 cents, where you then had to basically sell what used to be $1.15 to get your dollar.
So you had your income.
Yes, you're protecting against that volatility that the market gives us. That's one thing I can pretty much say. The market is going to give you volatility. So you have to protect. So you invest differently, but you're investing differently than that 25-year-old, but you're not investing differently. You're investing in many cases the same way that 25-year-old would do for the money that has the same type of goal. That 25-year-old, all of his money or her money is 15 or 20-year time horizon. For the 65-year-old, you're investing the same way with maybe a third, because some of the money has a long-term time goal.
Well, if you got a plan, if you're going to be around 30 years from now.
In doing this for over 30 years, I've only had one person over that period of time tell me, the question is, some people say, I want the last check. That we're talking to older people, we're talking about checks. I want it to bounce to the undertaker.
Right. I want to run out of money.
The day I die is when I run out of money.
Yeah.
And fine, we'll create that plan for you if you tell me what day you're going to die.
Yeah, that's obviously not.
I've had one person tell me the day.
Well, I don't want to hang out with that person.
They were basing it on their needs of life. And they gave me a date like June 18th or middle of June, 2036 or something like that. Like, and how did you come up with that?
Okay.
My twin granddaughters graduate from college, a couple days before that. After that, I'm not needed anymore, so I can go. And so I'm gone.
Okay, I don't want to hang out with that person.
Not that month. Before that, I do. If he's spending everything he's got.
All right, so it where we were leading, and as we said, this comes down to using a bucket strategy,
and it has to do with investing for the time frame that you're given, and the time frame isn't always just for the entire portfolio, because your portfolio has different needs. Even as a younger person, you may be saving some of your money towards buying a car. You may be saving some of your money for a retirement. They have different time horizons. Save appropriately, invest appropriately. As a retiree, you're going to spend some money in the next year, 2, 3, 4, 5 years, because you're retired. You want to have some life. And so you're spending money. The money that you need to identify, how much am I going to spend? I'm going to spend $40,000 a year. So identify the time horizon for 5, 6, 7 years. Put that money in cash. The next money you put, but you're and then you build your time horizon so that you have.
Yeah.
Well, if I've got my bucket number 1 and it provides me the cash flow that I need for the next 6, 7 years, and I put bucket number 2 in place that provides me the cash flow I need for another 7, 8 years, that means anything left over, I've got an appropriate time horizon for a 13 to 15 plus year time horizon. I can invest. And if it goes down tomorrow, I'm not going to worry because I'm not spending that money tomorrow. So I've got that covered.
Would you say that building a net worth requires taking some risk and using time, but keeping that net worth and making it last requires taking the kind of the opposite of risk and going in with a kind of paranoid fear that it could run out at any time? So we need to have some safe money on the sidelines.
I mean, that's one way to look at it. I like looking at it. Invest for your time appropriately for the time horizon for the money that you've identified.
Well, that's what you're doing. You're going to be aggressive because the young person has a 40-year time horizon.
Right.
So that's how you should, and you can take
and
some
a 65-year-old has a 20-year time horizon for some of the money, but not all of it.
But they've also
you have to be safe with some of the money and more aggressive with the other money. So
That's
it's a matter
good
of
stuff.
identifying what it is you're trying to accomplish.
Yeah, which is probably true for any age range.
It's true for any goal.
Yeah.
Identify the goal. At least identify some parameter of the goal. I don't necessarily know what my spending is going to be, but I know it's 15 years from now. Okay, I've got a time horizon I can work with. Now I've got an ability to, what kind of investments can I use? If I'm only 40 and I want to retire at 55, what kind of accounts can I use? Do I want to rely on 72T if it's all IRA? How do I access the money, make sure I get all that correct? But the first thing is, how do I invest it? I've got a 15-year time horizon. I know what my investment should look like. If I need the money tomorrow, next week, next year, I know what the investment should be. It should not be the stock market. It should be something safe if I'm going to spend my money next year. So identify when the event is happening, and that will go a long way to telling you how to invest. Yes.
You know what's great, as I look at this cassette tape from 1992, I have not obviously heard what's on this, but I can almost, the cool thing is I can almost guarantee you that the advice, the Buckets advice that you just gave me is probably going to be on that tape.
I wasn't there at that time, so I don't know what they talked about.
Well, I had to see who was on that, but
Yeah.
I can almost guarantee it because I know I was in the studio, maybe not understanding it all those years ago.
22 or something.
I was young, but yeah, and that's the cool thing about this. The philosophy hasn't changed over all these 30 plus years. You want to talk to the folks at Lucia Capital Group? They do this all the time. 800-644-1150. That's the number at Lucia Capital Group, 800-644-1150. Buckets, been doing it for a long time. And while different investments may have changed, time horizons, rules, and regulations and all that has changed, the basic philosophy, Professor Plum, has not changed at all.
No, some of the investments and the underlying investments change because of the interest rate environment and things of that nature.
Yeah, but
the
philosophy,
strategy, the philosophy, the idea of identifying time horizons, the idea of spending safe money, allowing more volatile money time to go through the ups and downs that the market throws at us, and it will throw at us. Let's protect ourselves from what the market takes from us. Let's use the market for what it gives us, but making sure that it fits within your strategy.
Find more online as well at luciacap.com, LUCIACAP.com. A lot of great resources there at Lucia Cap. Subscribe to this podcast, would you? Do us a favor. Do that. We get new subscribers every single week. Want to remind people you can do so on iTunes or Spotify. Subscribe and get every episode downloaded automatically to whatever devices you happen to be listening to. And we do thank you for your feedback. I got a couple of emails from folks based on one of our probably 3 weeks ago, so I'll have to bring that up to you next time. But Professor Plum, thank you so much.
You're welcome.
You're the Certified Financial Planner Professional. Professor Rick Plum, CFP. I'm your podcast host, Johnny Dean, here. Thanks so much for listening. We appreciate it, and we'll talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Target date funds are subject to the volatility of the financial markets, including equity and fixed income investments in the U.S. and abroad. and may be subject to risks associated with investing in high yield, small cap, and commodity related foreign securities. Principal invested is not guaranteed at any time, including at or after target dates. Before investing, carefully consider a mutual fund's or a target date fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. It's important to keep in mind that investments in fixed income products are subject to liquidity risk, interest rate risk, financial risk, inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.